It's still a very good time to buy because it's all about finding the property that's right for you. You are not married to that interest rate. You are finding the house that speaks to you. And in a tumultuous market is one of the best times you can get the house of your dreams, because if you can stomach the monthly payment and you can ride it out, then you can always refinance to a lower interest rate and still have what you want. And if you do buy a house that's a little bit cheaper in California, the property taxes are a bit more beneficial for you because they won't be calculated at that higher purchase price. So don't let the interest rates scare you that much. It's all about what your monthly payment is and how comfortable you are with that. So there's always deals to be found. It is where say the interest rate is 6.5%. The seller can pay the concessions to lower your interest rate by 2% for the first year and then 1% for the second year. So for the first year, the buyer would only be paying a monthly payment based on a 4.5% interest rate. And on a $700,000 house, that can be like $700 a month. So that really adds up. And then on the second year, they're saving 1%, which could be like $400 a month. So, I mean, you can save like $17,000 a year by having the seller supplement this. And if you do refinance before that 2 years is up, all that money that's held in the escrow account gets applied to your principal balance. So none of that money's lost, like if you were just buying down the rate. And I'm licensed in California, Nevada, and Colorado, and we are doing all kinds of fun things in every state to make it where more buyers can get in there and help people achieve their goals of homeownership. One thing he didn't address was about how much down payment you're putting on the property, because that can affect what your monthly payment is and how quickly you're recouping the cost on the rents. So with investment properties right now, you really need to be putting 25% or more down. You can get an investment property with 20% down, but your interest rates are going to be atrocious. Even at 25% down, they're still like not that awesome. So if you're buying an investment, be prepared for like 25 to 35% down to maximize your interest rate and also how many rents you'll be receiving from that property. You also want to check and see like what the property taxes are and where you're buying. Like if you're buying in California, be aware that it's 1.25% of the purchase price of what your property taxes are going to be. And that can be a lot. So if you're looking into like a multifamily opportunity, that can be wonderful. But you basically have to look at what the total rents are that you receive and what your costs are for buying the house, taxes, insurance, if there's any HOA dues. And then you should also apply a 25% vacancy factor to account for when people are moving out or transitioning. And then you also need to determine if this is going to be a long-term investment or if it's going to be a short-term rental, because not all areas in California you're able to do that. A lot of them, especially in the resort communities, are placing lots of restrictions on short-term rentals. So before you buy anything anywhere, you need to check on what the rules are for rentals in that particular area. And this is also a great opportunity to try to get the sellers to be more flexible and like pay for some of the closing costs or the 2-1 buy down or reduce the purchase price. And any of those things are going to help your investment property to be more profitable. But if you are a handy person or are able to do any of the repairs to the property itself, then if you can buy something that's a little run down, get it for like 30+% lower than what the market value is, put the touch-ups on it, and then try to rent it for a little bit more. And right now, actually, rents are skyrocketing compared to what they have been because there's very few places to live. People aren't buying as many houses, so the buyer demand is lower. There's lots of houses for sale, and the rents are going up. And so this is a good opportunity for you to still get into an investment property if you can cover the down payment. And just to piggyback on one other question that was in there, just to tie it in, it does help that the home prices are coming down even though the interest rates are higher, because you can always refinance down and lower your monthly payment. But you have to be comfortable with that monthly payment, what it is right now. Major things that you need to be thinking about, determining what your down payment flexibility is. And what I mean by down payment is like, yes, your initial down payment, but you also need to have money for closing costs and then also to furnish or fix up that property if you need to. So whatever you're budgeting, if your down payment amount that you're budgeting is $100,000, then I would try to have 125 to 150 grand available so that you can cover the closing cost or anything else that you need to do to the property right off the bat to get it move-in ready. You need credit scores are the biggest deal right now. Like if you do not have above a 740 credit score, your interest rate is going to suck. So you need to do everything possible to ensure that your credit score is as high as possible. If you are self-employed, make sure you're claiming enough on your taxes so we can actually use your income. Got to pay to play. So if you want to actually leverage assets and show how much money you make with your business, then claim it, pay your taxes on it, and then we can lend you more money. Let's see. Try not to open up any new credit cards or cars. Don't get a whole bunch of inquiries. Like inquiries can really, really hurt your credit score. If you're shopping for mortgages left and right, ask them to do a soft pull instead of a hard pull so that you're not getting multiple dings on your credit. And I did want to flip back to that other question for just a second because they were asking if it's better to buy or if real estate investing is easier if you already own a property. That is a dual part question. It can be because if you're trying to do like a DSCR loan, which is a debt service coverage ratio loan, that is based on the property's ability to debt service. And they generally want you to already have at least a primary residence or another investment property if you're going to do those kinds of loans. But the market changes all the time, and sometimes they take those guidelines away and you don't have to be an experienced investor. But one reason that it does work out in your favor if you're buying multiple primary residences is you're getting in those properties with as little as 3 to 5% down versus an investment property that's 25% or more. And you're able to capitalize on the lower interest rate with it being a primary residence. And you can stay in that house for a year or two. And then if you have enough equity in that house, you can pull some equity out of that house to help with your down payment on another property. And you can call it an investment property and put 25% down, or you could call it another primary residence and you could put less than 25% down, and then you can make your current primary residence a vacating primary and turning it into a rental, where you have that rental property at a much lower interest rate than you would if you were doing it as a traditional investment. So number one thing to remember is the most amount of millionaires are made during recessions and from real estate. Lean in. It's okay that prices are going down. It's okay that interest rates are going up. It just means that you're going to have more opportunity to get stuff because there's less competition. So lean into that discomfort and go for it, because who knows what doors it can open up for you. And my other piece of advice is for real estate investors, there are other options besides cash and hard money. I have them. I have wholesale lenders that work with real estate investors to give you lines of credit so that you can have cash and buy a property in like a couple days, and then it gets flipped back into your portfolio. And one of the big things I wanted to do when I got into the mortgage business was to provide better financing options for contractors and real estate investors beyond their own cash and hard money. And so I've got some highly competitive deals for people who don't want to do hard money. And there are always options out there. Just talk to people who know what they're talking about. There are lots of avenues to get money, and they don't all require hard money. They're like HELOCs, and leveraging your equity on your house is one of the best ways to do that.